Markets have been reaching record highs this month, but is there something stirring beneath the surface investors need to watch out for? Let's go to Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Thanks for joining us today.
Thanks for having me.
First, let's talk about the relative strength of the North American markets. Is this still all AI?
It is for the most part, and as well the tangential sectors that benefit from it, like the industrials.
Okay, so what do you see happening below the surface?
Well, there's about 47% weighting in 20 individual companies that represent the S&P. So about 4% of the S&P companies represent, almost half the weighting there. Below that, there are some seams of opportunity that of sectors and groups that have, let's just say, the multiples have contracted.
Okay, so talk to me about the sectors you're seeing and what else is going on with them.
Well, for example, consumer staples is a perfect example. Yes, perhaps there's been a slowdown regarding volumes within the consumer staple market, but overall the multiples, whichever way you look at it, are hitting multi-decade lows. So those are really quite attractive, growing, profitable, well-capitalized companies with a rising dividend. But yet the market, because of its euphoria, you're really getting into multiples within the S&P 500 that are reminiscent of the late 90s, dot-com era.
Yeah, so there's that imbalance that we haven't seen for some time. Does that make you concerned about a correction or a bubble bursting?
Well, there is going to be malinvestment, and as you know, bubbles can continue far longer than they should. There is a tremendous amount of excitement that's warranted over the next 20 years, but I believe that there are many companies here today that are the darlings that 20 years from now, you'll look upon that and you'll say, boy, that was really a bad idea to invest in those companies.
So are you saying that the AI enthusiasm will last that long? AI will be a driver for that long?
Like the internet, which created a tremendous amount of productivity in the labor force and for driving the economy, we believe that artificial intelligence over an extended period of time, 20 years, will have material implications that are going to be quite profound. But you do have a rush of investment spending that needs to be justified by actual revenues and potential revenue growth. And that's the big question. So there are many companies that their valuations have become quite distorted from historical ways of looking at it, because there is this assumption that these companies can grow far greater than the rate of GDP growth forever. And therein lies the distortion that we're talking about. So one just has to be really, really careful when thinking about what AI investment they want to invest in.
Does that mean we should maybe change the way we are looking at it, because we look back instead of necessarily looking forward when we do our comparisons, of course, and it almost opens up the conversation of we need to look at this market, the AI market, differently from how we looked at the dot-com market?
I wouldn't do that. That's how you get yourself into a lot of trouble, because what happens here is that many times, yes, there will be companies that their business models that are publicly traded are going to be challenged in quite a material way. But I would stick to reasonable assessment of growth rates and discount rates when valuing these individual companies. They still have to earn a profit over an extended period of time. So that's what I think where the rubber meets the road. With that said, there are some real well-established companies in the technology world that will benefit over the longer run, like the likes of a Microsoft, for example.
Yeah, Microsoft is one of your stock picks at this time. Tell me what you see in Microsoft that maybe you don't see in some of the others.
Well, it seems as if, as we all know, Microsoft's platform and their suite of software is embedded in all of corporate America as well as internationally. They've been able to transition into providing more cloud services and utilizing that deep connection with able to kind of shift where companies are now domiciling their data onto the Azure network. And by doing that now, they're one step away from now being able to leverage all of that data that's on their cloud to then sell into the world of artificial intelligence to create a labor force that will be exceptionally productive. Microsoft will benefit from that, and I believe this is the safe way of investing in artificial intelligence with a careful eye on this company growing, profitable, well capitalized, but looking 5, 7, 10 years out. One should just be mindful that when you're investing in a company like Microsoft, you should look out 5 years based off of where the valuation trades today.
Got it. You also like Colgate. Why do you like this company?
Well, like we were discussing consumer staples, Colgate has corrected in a material way. The top line growth for Colgate is roughly between 2 and 3%. Any type of upward bias on that assessment, which we believe this company can grow at 5% top line, would bode well for this company. It has very little debt. It is one of the largest consumer product companies in the world. And we think that this is a growing, profitable company that has a rising dividend stream. The market volatility of this company, or beta, is substantially lower than the S&P 500. So it's a well-diversified company that we believe is a core holding.
Let's get to your last pick, Republic Services. They do industrial waste collection. Is this something you see changing? Is there growth here?
Yes, absolutely. It's not only industrial waste, it's also residential. And they're one of the 2 largest waste companies. And again, just to kind of like stay along on this thematic, growing, profitable, well-capitalized company. We think that there's going to be tailwinds as there is this reindustrialization or at least a modicum of growth coming from building and reindustrialization here in the United States. That should bode well for their volumes overall. So you're getting not only waste pickup in regard to collection, but it's also a recycling company, as well as what they're doing is they have a well-rounded business model where we believe cash flow streams will just be very, very steady Eddie.
Chad Morganlander, I've got to leave it there. So thanks for your time. Chad, Senior Portfolio Manager, Washington Crossing Advisors.